The S&P 500 seeing its first record high since July 26th, the milestone coming just a day before the Fed meeting. BTIG's chief equity and derivative strategist Julian Emanuel is following the action. Julian, great to have you back.
Great to be here.
You think the Fed is going to cut? You changed your mind.
We do. Yeah. Look, if we've figured something out over the last year, the Fed does not like to disappoint the markets when the markets are so heavily skewed. And the odds on the board are now over 90% of a 25 basis point rate cut. That having been said, we think they'll take the opportunity to deliver what we'd call a hawkish cut. Essentially, look, we've cut 3 times. The economy is going to grow at 2%, give or take. The jobs market is very strong. And let's wait and see, how the 3 cuts filter in through the economy. We know these things work with a lag. And the stock market's at an all-time high. And we have potentially positive geopolitical catalysts the next several months. It's a good time to hit the pause button.
Do you think that a hawkish cut, won't that be just as bad as no cut? And saying data dependent, we leave things open?
If it's painted the right way, not necessarily. Do we think the market could pull back if that message is delivered? Absolutely. But unlike the other pullbacks of the last couple of years, we'd be buying the whole way down rather than letting the dust settle. Because basically, the other thing that the Fed's doing and doing quite well is controlling liquidity through, the money market mechanism and letting the balance sheet expand. Don't call it QE. They don't want to call it QE. But the fact is that the balance sheet expansion, if you look at the last 2 years, with all these volatility spikes that we had and brushing up against, 3,000 plus and not getting through, it's because the balance sheet has contracted. They've gone sort of hand in hand, and now we're approaching a time of greater liquidity.
So, Julian, I'm curious, where do you stand then on this quote-unquote mid-cycle adjustment? It sounds like you're more leaning towards that this cut was a mid-cycle adjustment, or the first cut was a mid-cycle adjustment.
Well, they're not going to come out and say it specifically because the fact is, again, though we do think there's going to be some sort of deal signed with China, and we do think Brexit will resolve favorably, they may not. So they're still going to be in risk management mode, but they're going to step back and say, look, we need deterioration or we need adverse developments to get more aggressive. And look, you may see more dissents. You had 2 dissents last time. Maybe you'll see a third. Who knows?
So you'd buy all the way down because of the increased liquidity that the Fed is putting out there. What's your target then for next year, let's say?
So what we have said all along about this year, and this goes back to January.
You sound defensive.
Well, our year-end 2019 target is 3,000.
Right.
We have said all along, going back to 2450 in January, that if we were wrong, it's because the market was going to blow through our target. We don't think it's necessarily going to occur this year, but looking out into the first half of next year, a number like 3250 is entirely possible. That represents the average multiple on trailing earnings that we've seen over the last 30 years. And let's remember, we've traded at a discounted multiple for the majority of the last couple of years, even though interest rates are as low as they are.
3250 in the first half of the year.
Entirely possible, yep.
Julian, great to see you. Thank you.
Thank
Julian
you.
Emanuel, BTIG. I like how the Fed says don't call it QE. But it feels like every single strategist on the street is calling it QE.
Well, it was the same equation was made when they were tightening. That was basically shrinking the balance sheet was equivalent to raising rates. So this is the equivalent to cutting rates, and that's why you have to be bullish the overall market.
Yeah, I just want to say one thing really quickly. The market trades horribly, even at all-time highs, when you consider that we are in a mid-cycle rate cutting cycle.
Worst chart you've ever seen.
We have QE. No, I'm just saying it trades horribly year over year, up 3.5%, given all the accommodation and all the potential catalysts that people like you see.